Hi there, and welcome to today's presentation called Quantum Leap. Today we're going to be talking about raising capital and negotiating better deals. So what's today's purpose? Well, it's to introduce you to 4 big challenges preventing investors from achieving their dreams. First, I should introduce myself. Who is Ken Beaton? Well, I am president of ARCA Real Estate Investments, where we own well over 100 rental units. I'm also president of ARCA Property Management, where my team and I manage 300 plus rental units for other people. I'm also a full-time educator for my company called ARCA Wealth Academy. This is my true passion, where I'm able to help other people achieve their financial goals through real estate. I'm also author of Creative Real Estate for Canadians and How to Buy and Manage an Investment Property. Despite going to college for civil engineering technology, I am a lifelong entrepreneur because I discovered early on in life that I didn't make a very good employee. I'm also a husband and father to 3 beautiful daughters and 6 gorgeous grandchildren. All right, so let's get started here with what are 4 big challenges preventing investors from achieving their dreams. So the first challenge I see is terrible negotiation skills. Now most people, not all, but most people, what they do is they simply make an offer where they're asking for everything under the sun that they want included in the transaction, and they expect to get it. Then they're surprised when their offer is countered at a high price or it's outright rejected. Well, let's take a look at how we actually negotiate. As an experienced realtor and an investor, I become frustrated with investing clients who overthink it. And what do I mean by overthinking it? When they take a look at a property, they see all the numbers, and I'm talking an investment property here. They see all the numbers and the numbers work, they still overthink it. And they want to go take a look at the property. Then they want to think more about it and review the numbers again. In the meantime, somebody else has come in and bought that property. Or they might want to lowball it. And then they get upset because their offer is rejected. And they can't even do a counter offer because it's been rejected. Overload the offer with clauses, multiple clauses, far too many clauses. I understand what the purpose and intent is for these clauses, but the bottom line is we don't need to have all of those clauses in every transaction. Simply looking to take, leaving nothing on the table for the seller. That's how I see many people negotiating out there. Now, many investors have the belief that all real estate agents are good negotiators. Now, don't get me wrong. There are some really good real estate agents out there who are top-rated negotiators. But the bottom line is most real estate agents are not very good negotiators. This is not a skill set that is taught very well when they obtain their real estate license. This is something a lot of people have to seek out and learn how to do after they have their license. Many investors also believe that they simply ask for what they want and they're going to get it, and that they want to squeeze every penny they can out of every transaction, every deal that they're involved in. They want to negotiate the best deal up front. They don't want to be going on and renegotiating after the fact, so they go in hard at the very beginning. And it's all about the buyer, and I'm talking about the person making the offer. They don't give any thoughts or concern about the person who's selling the property. It's all about them. So what are the results of poor negotiations? Well, when you make lowball offers or insulting offers, what happens is you're going to anger and repel the sellers. They're not going to want to deal with you. Even if you throw a lowball offer which gets rejected and you go back with a more reasonable offer, the seller could very easily say, I do not want to deal with that particular buyer. You're also going to frustrate your realtors with multiple failed offers. If all you do is you keep throwing lowball offers or you keep structuring your offers in such a way that they are rejected time and time again, then your real estate agent is going to become very frustrated and they're not going to want to work with you. You're also going to create a bad reputation in the industry. And for myself, I live in a market of over 1 million people. And there are a handful of people that everybody in the city knows about and you don't want to be dealing with. You do not want to be one of those people. Some more results are that you lose potential deals. So because you put in that low ball offer, or you structure the offer incorrectly at the very beginning, you're losing some really good opportunities. Not only that, but you're losing future deals as well. Your realtor may not want to work with you. They've got a good deal coming to the table, but they know that you are not a very easy person to work with. So what they're going to do is they're going to take their deal to somebody else that they know they can work with more easily. Now I'm going to share with you some recent lost deals. Recently I was working with a young man who was buying a single family home that was going to be converted into a suitable basement unit. The property was ideal for suiting because it fit into our education model for the program called 5 Homes to Freedom, where you find a home, you suite it, and then you make it into a duplex. In this particular case, it was an elderly lady living there, so the house was a little bit dated, but it was in excellent condition. It was an ideal candidate for what my client wanted to do with the property. There were multiple offers on this property because it was in an ideal neighborhood, was well taken care of. It was a good family home, so I knew it was going to be very popular. We took action and we made an offer very quickly. The challenge was that my client was a little bit nervous, wanted to make sure that he was going to be able to do what he wanted to do with respect to the zoning in the municipality. So put in a few extra clauses that I wouldn't normally put into an offer. I didn't foresee the problem though that we were going to have. And what happened was the elderly lady, when she looked at the offer, our offer was much better. It was for more money than the competing offer. It was more flexible. We could close it as early or as late as she wanted. If she wanted more money up front, my client was willing to do that. Everything was better except that we had put in this one clause stating that my client wanted the right to make sure that he could suite the house. When the elderly lady found out that her home was going to be suited into a duplex, she refused our offer. Had nothing to do with the price, had nothing to do with who he was. It had everything to do with what was going to happen to the home in the future. It was totally irrational from the lady's perspective. It was unfortunate, but it was one of those things that we could have avoided if we had structured the deal much differently. Another situation was with a small 11-unit apartment building. This building was in excellent condition. It was marketed at a fair price, therefore I knew it would likely sell extremely fast. I introduced it to a client of mine, and he insisted on going to see it first. In the meantime, other people were looking at the property and they were making offers on the property as well. Negotiations for multifamily properties are very different than they are for single-family homes. So if you are a single-family home buyer and you're looking to get into investing and you want to start making offers on multi-unit buildings, you need to understand that making offers and negotiating is very different than buying single-family homes. Even if you're already in the game, you need to understand there are a lot of different ways to write your offers so that they'll get accepted. There's a lot of ways to write the offers so that you can get yours accepted while other people are going to look at the property. So as a result, my client, because he wanted to go take a look at the building and review the numbers a little bit more before making an offer, he was using the mindset of a single-family home buyer. He lost out on the transaction. There were multiple offers. He wasn't even in the game for this particular case. So I'll share with you an example of how it can be done. This is a deal that I did a number of years ago, and it was an 8-plex, 2 buildings side by side, total of 8 units, and over a period of 6 months I made a profit of $80,000. So the original asking price was $450,000. The final price that we agreed upon was $150,000. Why so low? Well, it was a very tired, rundown property. There was no debt on the property. The elderly gentleman who owned the property, he He thought it was worth much more than it actually was, and in his opinion, it cash flowed very well, but it didn't cash flow very well if you put conventional debt on the property. Once you put conventional debt on the property, the value plummeted down to a value of below $200,000. So we negotiated the final price of $150,000, and I wrote the offer for $250,000 with $100,000 cash back. This is a very strategic way of writing my offers. I then did a 6-month hold and repair, so knowing that the after repair value would be upwards of $400,000 when we got good tenants in there paying market rent. The selling price of $300,000 with a $75,000 cash back after 6 months ended up being almost a 7-month hold with an $85,000 profit. I did this with no management, no work, and no cash. I also negotiated with the original buyer 100% vendor take-back at 9% interest. This vendor take-back mortgage had an interest-free period for the first 6 months, so there was no money out of my pocket. The new buyer, who I was going to be selling this property to in the 6-month time period, they agreed to manage the property for free, collect all the rents for me, put them in my bank account, and I would pay the taxes and the insurance, etc. They would do all the renovations to the property to increase the value of that property upwards of $400,000, and they were doing all of these renovations at their cost. So let's take a look at these numbers. Again, I purchased it for $150,000, yet on paper it looks like I bought it for $250,000. I did the 100% vendor take back at 9%, zero interest for 6 months. I sold the property for $300,000 less $75,000 cash back, so I sold it for $225,000. My profit in this deal, $225,000 minus the original $150,000 is $75,000. Plus, I held it for just a little over 6 months, so my rental income was $5,000 during that time period, for a total of $80,000 profit. And again, I bought it up front, but I didn't manage it and I didn't do the work to it. I just facilitated the transaction and I negotiated the deals on both ends. So let's just do a little summary here and take a look at the original seller. The original seller was very happy to have sold a tired, rundown property. This seller was somebody I had dealt with prior in another transaction, so he was familiar with who I was and how I operated. And he was very happy because I took this tired, rundown property off his hands and he was able to walk away free and clear, no headaches, no hassles. Myself, as a real estate investor, I saw this great opportunity to own and control a property way below market value with great potential, with an opportunity to generate $80,000 profit in a very short period of time with very little to no effort. The final purchaser was somebody I knew as well, another investor. They were very happy to acquire another cash flowing property for their portfolio. Also very happy to experience huge potential equity growth. Now they're currently about to realize a $275,000 profit, give or take, with the sale of this rehabbed property, because they're just about to put it on the market for an asking price of $500,000. So that will generate a $275,000 profit for the student. So this is truly a win-win-win situation where I negotiated a really good deal with the original buyer. It was a fair deal for both sides of us. It wouldn't, if it wasn't fair, he wouldn't have agreed to it. It wasn't as if he was an uneducated investor. He was a very educated investor as well as a legal lawyer. So he knew what he was doing. It was a win for me because I made $80,000 very quickly and easily in a short period of time. And it was a win for my buyer because they were able to put a cash flowing property into their portfolio immediately, plus have a nice windfall when this property sells. All right, so let's get on to the second challenge, and that's lack of support. Now I'm talking about lack of support from family members, your friends and co-workers. It could even be from realtors that you're working with. This is a big one where you're looking for a real estate agent to represent you and work with you, and they don't understand fully what it is you want. You expect them to be educated in every aspect of real estate, but they really are not. They're just, the vast majority of realtors are home sellers. Also, your team, your lawyer, your accountant, all of the different members of your team, you want them to be able to support what you're doing, believe in what you're doing and why you're doing it, and help you. Now, lack of support results in many things. One is frustration. This is a big one where I see a lot of people simply get frustrated with the lack of support around them and they give up because they haven't been encouraged. This also feeds lack of confidence. If you don't have those little wins, you don't build your confidence. So a lack of confidence causes you to give up as well. Costly mistakes. If you don't have a good team around you, guiding you down the right path, helping you along the way, it can cost you mistakes. It can cost you if you pay too much for a property, if you buy the wrong property, if you buy a property that needs too many repairs. It can also cost you in missed opportunities. And this one is a huge one because you don't know what the cost actually is, because these missed opportunities you'll never see. Now, a lack of support example, this is more about your beliefs and mindsets, ours and others. And it's about our team will reflect who we are. So what we believe and what our mindsets are going to be reflected in our team members as well, because we're going to want to work with people of similar mindset. So if you've got a scarcity mindset, or if you suffer from lack of confidence, fear of losing, etc., then you are going to be attracting team members like that as well. Now, what you need to do is keep in mind that all of these fears are false evidence appearing real. But regardless, you are going to attract what you put out and believe in. So I'm going to share with you two scenarios, two very different scenarios with very different results. The first scenario is a student of mine. His name is Todd. Todd was investing for a number of years, I think 8 years in total, prior to coming to me. He had hit a wall and was unable to buy any more properties. He attended some personal development courses, which helped change his mindset, which also encouraged him to come and take one of my courses as well. So he signed up for one of my courses, and after the course, he was then able to raise in excess of $500,000 within 5 short months. This allowed him to do more deals automatically. He was able to grow his portfolio by 13 doors and increase his net worth by $100,000 within the first year. Todd has an extremely strong team. His lawyer understands what it is he wants to do, and his lawyer supports what he wants to do. Todd's very fortunate in that his father is his not only his mentor and his coach, personal coach, but he's also his home inspector, and he totally gets what Todd is doing and is very supportive. Todd has me on his team as a realtor. He has me on his team as a mentor and an educator as well. So Todd has been able to surround himself with a very strong team, and Todd is doing extremely well and is continuing. His portfolio has grown well beyond the additional 13 doors. Now, there's some very different results, though, with the second scenario. In the second scenario, a purchaser will buy 1 or 2 properties using their own money, and then they hit that wall. Now, that wall could be that they've run out of their own cash. They are no longer able to qualify for mortgages. They don't have money for the down payment. It could be a variety of things. So what they do is they go out and they sign up for more courses. They figure they need more education. Yet, they still surround themselves with the same team and the same support. And as a result, they get the same or similar results. The bottom line here is that if you want to experience different results, you must take different actions. So, lack of support example. I'm going to share with you a current real estate client that I'm working with. This gentleman, super nice fellow. He's a contractor, building contractor. He's married with a couple of young children. He's worked for us as a contractor on several of our properties, so he knows what we do. He understands the value of investing in real estate. However, he's got this Lone Ranger mindset where he can do it himself. He's also got a scarcity mindset, and he fails to see the value in paid education. He's always trying to learn from somebody else for free. He's currently making costly mistakes with a single family home. He bought this single family home, so he's only got one tenant, and when that one tenant vacates, it's 100% vacant. He bought it on a very busy street. It's not a very aesthetically appealing property as well. So it's currently sitting there vacant and has been so for a couple months. He's only owned it for a couple of years now, and he's already gone through 3 or 4 rentals clients. So it turns over quite a bit. As a result, he's lost the confidence and support of his spouse, his number one support person. Now, his spouse is very gun shy. He wants to go out and buy another property, but his spouse is saying, no, she's been, burnt. She doesn't see the benefits of investing in real estate. She understands the benefits of investing in real estate, but she just sees all of the hard work over the past couple of years with this single family home. So he's currently missing a great opportunity because of his scarcity mindset, the Lone Ranger mindset, because he's got the wrong support team around him. So what is the solution for lack of support? Well, it's key to network with like-minded people. Now, this could be at paid learning events where you actually pay to attend an event. It could be an education event. It could also be an investment club where you pay a modest amount to go on a monthly basis and learn from guest speakers, but more importantly, network with other like-minded people. Or it could be at inexpensive meetup groups. Referrals from successful investors. So instead of trying to go out and build your own team all by yourself, the quickest, easiest, best way that I could recommend you do this is to go and build your team based upon referrals. Ask other successful real estate investors who they use for a lawyer. Who do they use for accountants, realtors, etc. Also, this is a huge one. Find an accountability partner. Somebody else who's in the industry doing or wanting to do what you're doing, and do it together. Help each other along the way. Hold each other accountable as well, and you'll see exponential growth. All right, challenge number 3, and this is a big one for many people, is lack of money or joint venture partners. Now, it could be that you run out of money and you hit that wall, or you may not have any money to begin with. Either way, at some point in time, you're going to have a challenge with money and or attracting joint venture partners. Now, a lot of people say, well, I don't know anyone with money, or I don't know how to approach a potential partner or investor. I just don't know how to do it. Then you start to question yourself, why would they invest with me? Or you might have money, but the banks say no. And this is a big one these days because the bank rules keep changing. So when the bank says no, what do you do? Well, most lack of money and joint venture partner issues come back to the investor. That's us. And it's our lack of confidence. It's our fear of rejection. It's all of our subconscious issues internally that hold us back from going out there and attracting more money, attracting joint venture partners. So what is this going to result in? Well, it's going to result in missed opportunities. Because if you simply don't have the cash to take action, you're going to watch opportunities come and go. It's going to cause you to fail to achieve your own personal goals as well. And this is one a lot of people don't even think about. It's going to cause you to fail to help others achieve their goals. So all of these joint venture partners or hard money lenders, these people who are in the business of lending money in real estate, if they're not lending it to you, then they're missing opportunities to make money and a return on their investment to achieve their goals as well. And the bottom line is you're going to keep getting the same old results as you have in the past. So what is the solution for lack of money or joint venture partners? Well, the first thing I suggest you do is identify and embrace what your unfair advantage is. So what do I mean by that? Well, your unfair advantage, as a quick example, could be that perhaps you are an accountant or a bookkeeper. Well, your services would be extremely important to a joint venture partnership where the other person is the investor and they've got the time, money, and energy to invest in real estate, and you've got the background and the cash. Or you could be a plumber or a tradesperson, a carpenter or an electrician, any trade at all, just a handy person. And you've got the skill set to do the work, you've got the skill set to find the properties. You just need a partner who's got the cash and the wherewithal to qualify for mortgages. So identifying what your personal unfair advantage is, and then learn how to leverage that to help other people achieve their goals as well. Sometimes you need to ask for the help and guidance of family and friends in order to identify what your unfair advantage is, because we can't see the forest for the trees sometimes when we're right in there and we don't see what we are really good at. But those examples I gave you already can certainly help get you started. Identifying great deals. Learn how to find great deals. Learn how to identify whether it's a good deal or a bad deal so that it will be of interest to joint venture partners. It will be of interest to a bank to lend money. It will be of interest to a hard money lender to lend money to. If it's not a good deal, then nobody's going to want to touch it. Understanding what your investor or your partner's wants and needs are. This is huge. A lot of people automatically approach an investor or a joint venture partner thinking that they just want to get in real estate without truly understanding why they want to be investing in real estate. You need to build a connection so that you can understand what their needs are and give them what their needs are, not necessarily what their wants are. But if you don't know what their needs and wants are, and you just make assumptions, then you're not building a good relationship. You're not going to have a good partner. Learn to present these great deals to your partners. So once you know you found a really good deal, once you understand what your partner's needs and desires are, you then need to learn how to present it in such a way that they will want to invest with you. So it's like a balancing act between their wants and their needs. If you just give them all of their wants, not satisfying their needs, then the deal may not work. And vice versa. Just give them what their needs are, but doesn't satisfy their wants, that won't work as well. But if you don't identify what their wants and needs are, it's very difficult to do a presentation and attract these people. So another solution is to open your mind to who may have money. So this is something that really blows my mind all the time. People say, I don't know anybody with money. Yet once I start talking to them, it's amazing the number of people that are around them that do have money. More often than not, they just don't want to approach them. They know they have money or they think they may have money, but they don't want to approach them to talk about it because they're intimidated by it. So you just need to open your mind to who may actually have money. For example, is it going to be that person who's well-dressed, drives a fancy car, works on Wall Street, those executives who spend every penny that they make and they look like they're wealthy? Or is it going to be the tradesperson, the local electrician, the plumber, the carpenter, who drives the beat-up old vehicles, lives in a very plain Jane house, lives a very modest lifestyle, but he and she works hard, and they save their money and invest it wisely. You can't tell by looking at a person who's got the money and who doesn't. So I'm going to share with you an example of having access, the beautiful thing of having access to other people's money and or partners. This is a property that I purchased. It's a 21-unit apartment building. I say it's free because what happened was I was able to purchase it with other people's money, plus put money in my pocket. So I'll just very quickly walk through how this process went. I purchased it with 100% private money. So the purchase price plus closing costs, I borrowed all of that money from a private individual at 12% interest. I then had to borrow more money to renovate that property because it was in such disrepair. So I borrowed more money at 12% to renovate the property. 1 year later, I refinanced that property with the bank money conventionally based upon its after repair value. I was then able to pay off all of the private lenders that I borrowed money from, and I was able to generate a nice little profit for myself. So when we closed that transaction, the bank financed that property, and my lawyer cut me a check for $321,895. My lawyer said this is the first time that he was actually paying somebody to buy a building. Another way is RRSP money. This is a beautiful way of raising money and using other people's money, because most people believe they have to give their money over to the mutual fund the mutual funds or the banks and all of these other companies that manage these mutual fund markets. Well, that is one source. It's not necessarily the best source in my opinion. However, what you can do is you can also put it into a true self-directed fund, and you can use these funds to invest in real estate. You can invest in your own real estate, or you can invest in other people's real estate. It's usually easier to invest in other people's real estate. So when I was doing rent-to-owns, for example, I would recycle my down payment. I would do one rent-to-own. I'd use my own money for the initial down payment. A month, 2 months later, after the deal was closed and everything was going along smoothly, I would borrow through somebody else's RSP fund the same amount that I put down on that property for the down payment, place a second mortgage on there with their RSP money. I would then take my cash back out of it and repeat the transaction with another rent-to-own deal. So it's recycling my down payment. It's also a great way to leverage debt equity. I recently wanted to start up a new small business, and I didn't want to touch the money inside my real estate account for this. I like to keep my businesses separate. So I was going to have to borrow money, $50,000, in order to get this business started. Well, instead of going to the bank and borrowing money, I knew of an investor who had $100,000 in RSPs. This investor also wanted to borrow $50,000 to put into his current business. So he had $100,000 in RSPs, but he couldn't access that $100,000 without taking it out of the RSP portfolio and paying massive tax on it. So what we did was he lent me his $100,000 against one of my properties that had some equity in the property, what we call dead equity. We created a second mortgage. I now have $100,000. I'm paying him 4% interest on that $100,000. That's $4,000 per year. I then have this $100,000 in my personal name. I can do what I want with it. I turned around and lent him $50,000 cash at 3% interest. Sorry, it's the opposite way around. I borrowed it at 3%, where I'm paying out $3,000. I then lent out $50,000 at 4%. So now I've got $50,000 with a very low cost interest rate, and I've lent money out to my friend based upon his $100,000 loan to me. It's just a matter of circulating that money, getting it working for us rather than it sitting there doing very little to nothing. All right, challenge number 4 is how we actually learn. Now let me just go through how we typically have learned in the past. So many of us would read a book, and the challenge that I've always experienced with most books is that the books will tell you why. They'll inspire you to take action, but very few of these books will actually tell you how to do it. The challenge with that is, well, it can be frustrating because you know you want to do something, but you don't know how to do it. Or worse yet, you might take action and make mistakes, which can cost you thousands and thousands of dollars. So that sort of leads us to the trial and error method of how we learn. And this is a good way of learning if you can afford the costs. Because with the trial and error, usually when you make mistakes, especially in real estate, it can cost you thousands and thousands of dollars. Now, I have made mistakes and I have lost, that have cost me money, but I've been very fortunate in that I've never lost any money in real estate. Like when I sell the property, I always make it back. So I've been very fortunate that way. But with trial and error, it is a long way of learning, and it's very costly, and it can be very frustrating as well. But it is better than just simply reading a book about it. Another way is to listen to those who think they know. Now, there's a lot of people who are willing to give you advice on investing in real estate. What you have to do is you have to ask yourself, what does this person really know about investing in real estate? So, for example, I know several people who have never bought a real estate investment property in their entire life, yet when you talk to them, it sounds like they are experts in it because they have opinions. Those opinions may not necessarily be true or accurate. So you always have to ask yourself, where are these opinions coming from? Are they valid? And then they're sitting in a classroom and listening to a lecture. Now, a little bit better than a book, but it's still pretty boring. But yet that's how most people still to this day typically learn. Now, excited to learn why, frustrated not to learn how, therefore doing nothing. You get excited, you take action and make costly mistakes. Learning from those who think they know can create costly mistakes or prevent you from even taking action and scaring you. Then actually attending some education courses to learn the how, but allowing those paradigms, your fear, your self-worth, personal rejection issues to control your actions. This is how we typically learn. It's not necessarily the best way. So this is an example of the cone of learning and how we actually learn. So you can see down near the very bottom there where it says reading, 10%, what we do is we will retain only 10% of what we read after 2 weeks. So you read that book, you become totally inspired, but 2 weeks later you've only retained approximately 10% of the information. If you listen to it through an audio, then you're going to retain maybe 20%. When you're looking at pictures, you retain 30%. Watching a movie or demonstrations, it increases by 50%. So you can see how the retention will increase through more activity. Now you get up into the 70 percentile, you're actually participating in a discussion. You're engaging with the other person. You're engaging your subconscious mind talking to this person, or you actually start talking to other people about what you just read. Now you're going to retain a much higher percentage of that information because it's being repeated within your mind. When you get up into the 90 percentile, that's because you're doing the real thing or simulating that you're doing the real thing. And the funny thing is, simulation and doing the real thing will have the same effect on your mind because your subconscious mind cannot tell the difference between doing the real thing and actually just visualizing doing the real thing. So the more active you are, the higher the level of retention. Now, why am I getting into this? Well, accelerated success happens when we participate in discussions. So being part of a mastermind group is a phenomenal way to participate in discussions. Doing simulations, practicing it, teaching it. So when you learn something and you want to share it with somebody else, it doesn't mean standing up in front of a large group of individuals, although that you can do that. But by sharing this information at your office, at your workplace, to your family, your friends, you're actually teaching it to others. Actually doing the real thing with a mentor, somebody who's already walked the walk, who knows what to do and to avoid those pitfalls. Plus, identifying and breaking through your upper limit barriers. Our upper limit barriers are things that prevent us from moving forward. It could be our belief systems. It could be our fears. It could be a lot of these things that we are not even aware of what's going on inside our subconscious that are preventing us from achieving the goals that we are aiming to achieve for. And networking with the right people. So how can you overcome these challenges? Well, join me June 23rd to 25th in Edmonton. It's an event called the Quantum Leap, where we will be focusing on raising capital and negotiating better deals. This is 3 full days. We will do masterminding with like-minded people, just like Napoleon Hill teaches in Think and Grow Rich. Think and Grow Rich is a phenomenal book that all of the real estate gurus, all of the most successful individuals in business have read Think and Grow Rich. Napoleon Hill talks about masterminding and the value of masterminding. So we will introduce that during the 3 full days. Learn how I do negotiations and how to structure some really great deals. Learn what to say and how to say it in order to attract money and joint venture partners. This is a live exercise where we actually interact with other members in the group over the course of the 3 days. Also focus on identifying what is holding you back and helping you overcome those barriers. This quantum leap will help you allow you to do more deals. By having more capital, you're going to be able to do more deals. More joint venture partners means more deals as well. And more deals simply means lots more money. And if you have lots more money, there's a lot less stress in your life and you're able to retire in comfort. Plus, this is a big one. This is what I love. You enjoy life more. So my wife and I just returned this past January from a family vacation where we took 3 of our grandchildren on a Disney cruise. We've recently bought or built our new home. We've traveled the world. We're doing things in our neighborhood, our local environment here. We're just enjoying life more because we can. So what is your investment for this? Well, typically a 3-day weekend event can easily cost you close to $3,000. I've paid as much as $5,000 and more for a 3-day event. Well, that's not what your investment is going to be. Your investment is only going to be $197 plus tax, and you're able to bring a guest for only $97 plus tax. If you've got more than one guest, that's fine. You can bring as many guests as you want for $97 per person. Now, $29.97 for 3 days, knocked down to $197. I know what many of you are thinking. This is a scam. What's going on here? Why such a low price? Well, I want to provide full disclosure. There's no gimmicks, just great value. Plus, at this event, I will be introducing a new year-long mentorship program. Now, if this program is not for you, not an issue. My style is not to pressure people or guilt people into anything they do not want to be part of. Come to the weekend event, enjoy it, learn lots, network with lots of like-minded people, and you'll have a blast and you'll learn lots and take your investing to the next level. So if you're interested, all I ask is that you register now. For $197 plus tax, bring a guest for only $97 plus tax. Instead of typing that long-winded address in there to register, all you have to do is in the email that you received this webinar on, there will be a link there that you can click, which will take you to the registration page now. Now, let you in on a little secret here. The secret of success of every person who has ever been successful lies in the fact that they form the habit of doing things that failures don't like to do. Now, I can speak from personal experience. My wife is a very successful realtor. She's only been in the industry for 3 years now. She's already at the top of the industry in her market, and that's simply because she has formed the habit of doing things that failures don't like to do. The other agents who don't like to do the cold calling, don't like to get on the phone and talk to strangers. All of these little things that are intimidating, uncomfortable, my wife is willing to do it in order to be successful. That's what you have to do, is do what other people are not willing to do. Now, at this Quantum Leap weekend event, there's not going to be any failures there because people who are coming to this weekend event are not failures to begin with. These are people who want to get to the next level, and we are going to be there to help you get to that next level, whatever it may be for you. So again, the investment for you is only $197 plus tax. Bring a guest for $97 or as many guests as you like, and I look forward to seeing you at the event. Take care now.